only mode.
Good afternoon. Welcome to the FIIG Securities webinar this afternoon on why 2013 is the year to de-risk and diversify. My name's Elizabeth Moran. I'm Director of Education and Fixed Income Research, and today I'll be your host. My colleagues who are presenting are Justin McCarthy. He's Director of Financial Institutions and Corporate Research. Now, Justin has many years' experience in credit markets, over 18, and in fact started his career as a chartered accountant. But he's held credit positions with major banks overseas, including Credit Suisse in London and National Australia Bank in Hong Kong. He's been with FIIG now for 6 years and is responsible for financial institutions and corporate research. The other presenter is Will Arnold. Will has recently joined FIIG in August last year, and he came from QTC. He also has extensive experience, including 10 years in credit and fixed income, working for fund managers, banks, and also 6 years in London. So I have a great wealth of expertise at FIIG and very happy to present today. So Will speak first on credit spreads and financials, and then Justin McCarthy will speak on why 2013 is the year to de-risk and diversify. And Justin will then conclude with which bonds we're recommending to reduce and which to add. Now, before we really get into the swing of things today, just want to do a little bit of housekeeping. On the right-hand side of your screen, there should be an orange arrow and a panel. Now, if you can't see the panel, if you click on the orange arrow, that will expand, and there's a place further down the column where you can see questions. So while we're presenting today, if you'd like to ask us any questions, please type them, and we'll attempt to answer them as we go through or at the end of the presentation. And if we're pushed for time, we'll either email you or call you after the presentation if we don't get to your call. So I'd like to hand over now to Justin to commence his part, Will, his part of the presentation on credit spreads and financials. Thanks, Will.
Thank you, Liz. Hello, everybody. I'm going to cover a few topics this afternoon. I'm going to start by talking about the market over the last 6 months and what's been happening. And then I'm going to talk about issues on the horizon, and then give details of individual securities and how investors can take advantage of current conditions. So just moving to the next slide now. Okay. This chart shows the Australian iTraxx index over the last 6 months. This is an index of credit default swaps, or CDSs, and they can be viewed as an insurance contract which will give protection and compensation to the buyer in the event of a loan default or other credit event. So this is therefore an indicator of perceived credit risk in the market. The higher the spread, the higher the perception of credit risk. So this Aussie iTraxx index is therefore representative of the Australian credit markets over the last period here. What this chart demonstrates is that spreads have tightened significantly over the last 6 months, i.e. the perceived risk has reduced, and credit securities have rallied in price. Now, this is a key driver of our view that it might be time for investors to reassess their portfolios and look for opportunities to switch from a higher to a lower risk securities. Now spreads have converged, and that's a concept I'll illustrate a bit later on. So just moving across to the next slide. So why the rally? In very general terms, credit markets have been trading driven by macro conditions, notably in Europe, as well as the US. So progress in Europe. During the last half of 2012, the market responded very positively to various events in Europe. In mid-June, leaders of the EU reached agreement that the EU has flawed financial architecture and they need and are going to fix it. They reached agreement around moving towards more banking union, fiscal union, economic union, as well as higher degrees of political union. They also demonstrated that they'll do whatever it takes to avoid worst-case scenarios. So while not necessarily proactive, they have acted when necessary to avoid potentially dramatic scenarios, such as a country exit. So important precedents have been set, including significant financial backing, as well as far-reaching policy changes, all to preserve the financial system. Also, what's happened is the market has also returned for more vulnerable peripheral country debt, which reduces funding pressures in these areas given more investors. Okay, just on to the next slide. Now the US, in the run-up to the end of the year, investors were viewing Eurozone risks as benign compared to those associated with the US and specifically the US fiscal cliff issue. Now this chart shows the Aussie iTraxx again, but just over the month of December and into January. And fears over the fiscal cliff put upward pressure on spreads in the run-up to the end of the year. But once some form of agreement was reached in early January, markets responded as reflected in the middle of this chart, where the iTraxx contracted some 7 basis points overnight. Okay, now just moving on to the next slide. Issues on the horizon. So financial securities have been trading to some extent as though the crisis is over. This is, however, more of a reflection that investors perceive the probability of significant events, significant events have decreased. Events such as the breakup of the union or countries losing market access with no effective backstop. So in this regard, the situation has changed substantially. However, fundamentally, Europe continues to struggle with low economic growth, high unemployment, and generally, well, weak conditions. So in this regard, the crisis does continue. Other macro risks to note include, in Europe, they still need to get around 20 or so countries to agree and then execute a significant long-term, like 10-year plan of redesigning the whole economic fabric of that region, as well as trying to do this during recession. And in the US, concerns still exist regarding the political management of the fiscal cliff, as well as longer-term issues such as entitlement reform and debt management. So while the House passed a bill to suspend the debt ceiling on the fiscal cliff, it had only done that until the 18th of May this year, and agreement by both the House and the Senate is still needed. And also a budget resolution is also required by April. Further on to that, banks also have a long way to go to fully adapt to the new market and regulatory environment. So ultimately, the performance of financials in 2013 is likely to be driven by decisions of policymakers, mainly in the US and in Europe.
Now, Will, we've got a question from Andrew. Andrew would like to know if there's an iTraxx index for the US.
Yes, Andrew, there is. iTraxx is I guess it's a bit of a brand name, and they have indices tracking most markets. So short answer, yes, they do.
And we actually have another question here from Gary. Now, Gary's asking, as a general rule, is it more important to focus on the company's credit rating, you know, whether it's an A- or a BBB+, or whether it's important to focus on the type of bond, whether it's a senior debt or a Tier 1?
Well, it'd have to be a mix of those. So and macro conditions as well. So, for example, we're talking about financial credits, and those have been driven primarily by larger external pressures. But you assess the whole range. So you assess the country, political risks, risks associated with regulation, as well as the company itself, as well as the security you're holding, to get a full picture of the riskiness of your investment and whether the return is sufficient.
No, that's good. I think that's always important, that you're looking, or we're looking as analysts, is the reward enough for the risk that you're undertaking. So it's very definitely an assessment of the risks and the downside, and are you being paid enough. So you can have a very large company that's as an issuer itself rated very highly, it might issue a Tier 1 hybrid that's rated a triple B or a flat or a triple B minus, but if you have a lot of confidence in that company, you're quite happy to come down that capital structure for the higher return. So I'm hoping that gives you a bit of an insight, Gary, and we will move on to the next slide, and I'll hand back over to Will.
Okay, thanks for that, Liz. So basically, I'll now talk about how the rally and the current market conditions can be used in an investor's favour, and I'm using an example here of US banks. Now this chart again shows CDS spreads for 6 major US banks. We've got Citigroup there, JP Morgan, Goldman Sachs, Morgan Stanley, Wells and Bank of America. And you can see here how spreads have increased mid-year as concerns over Europe increased. Then as backstops were put in place and progress was made, spreads tightened as investors became more confident that, I guess, amongst other things, the European Union would not break up. So this chart shows a separation between what the market considers higher and lower risk credits in this sample. Perceived stronger credits of JP Morgan and Wells Fargo are along the bottom of this chart, and they exhibit lower volatility than higher risk names such as Goldman Sachs and Morgan Stanley, the lines across the top that exhibit a lot of volatility. So at mid-year, investors were paid a large premium to hold perceived riskier names such as Morgan Stanley. They're in red. So the additional spread when compared to, say, the lowest risk name in this sample, which is Wells Fargo, is around 350 basis points at mid-year. So that's the difference between the bottom and the very top lines in this chart. So, but currently, however, the rally has caused spreads and therefore risk premiums to converge, and we can see this towards the end of this chart. This means investors holding a higher risk name such as Morgan Stanley are now paid less of a premium compared to the point in the mid-year, for example. So the spread is now reduced to around 100 basis points for over those 2 securities. What investors are able to do in such a scenario is to trade a higher risk for a lower risk name, taking a capital gain and also giving up only small yield differences because of the compression over that period. And then they have the option to trade back in if conditions deteriorate and higher names start providing better value again.
Will, we have a question here from James, and I'm not sure if Justin wants to jump in on this as well, because Justin's explained it many times, but James is asking, please explain what a CDS is, a credit default swap.
I'll take that, Will. A credit default swap is essentially a indication or a proxy for credit spread. So they're actually used as insurance against credit defaults by those names such as Morgan Stanley. So in this context, the use is really as a proxy or a very good indication of where that credit margin would be if, say, Morgan Stanley was to issue a bond. So in this case, back in June 2012, if they were issuing a 5-year bond in Australia, for example, they would have paid the 5-year swap rate, let's say it was 4%, plus an additional margin of 4.5%. So that being the 450 basis points or 4.5%. If they were to do that now, as Will was pointing out, the margin would be only 200 basis points or 2% over that 5-year swap rate. So it's an indication of the credit worthiness or credit spreads. Hopefully that helps.
Thanks very much, Justin. We'll move on to the next slide. Back to you, Will.
Okay. Yes. Thanks for that, Justin. Okay. Now this next slide is just an example of some of our more popular securities which have rallied in recent times. This chart shows Morgan Stanley and Societe Generale, and unlike our previous slides which show the credit default swaps, this shows the actual price of these banks' senior bonds. So you can see with Morgan Stanley on the left there, for example, its May 17 bond, which is illustrated in the light blue line, has rallied from around mid-year at around $104 up into about around $112 now, which over that period is about a 7.7% return, capital return. And for comparative purposes, you know, that'd be around a 14% return when annualized. And the point of that, that's a large return for a senior, lower risk bond at a large financial institution. So these are some examples of securities where investors could look at reassessing their holdings, take some risk off the table and look for a better risk return value.
Okay, well, we've got a couple more questions, and I'm just going to take the listeners back to the previous slide, because Andrew has asked how would the Australian banks compare to the US banks in terms of their spreads. So I'm not sure, Will, if you're up on the Australian banks. I know that Australian banks are issuing much tighter margins currently in overseas markets. I'm pretty sure ANZ got a $1.25 billion US issue away last week, and that was, when it was swapped back, it was about 67 basis points. So that was sort of the spread, really tight, cheap money for them at the moment. Hoping that explains that. So still, our Aussie banks are seen as very low risk and safe on the international market with the oligopoly that they have here. Got another couple of questions. Peter Williams, oh sorry Peter, shouldn't have mentioned your last name, has asked, are the shocks to the general market still out there, albeit less of an impact? And therefore, is it a permanent change to spread levels? So, Justin, do you want to have a go at answering that one?
I guess that's part of our theme in why 2013 is the year to de-risk and diversify. The answer, the simple answer is no one really knows, but we think that there's certainly a number of macro issues that haven't been resolved. So, to use the often used term, kick the can down the road, we think that things like the fiscal cliff and a lot of the problems in Europe, they haven't actually been addressed. They've just been pushed further out. So we think that there are a number of macro concerns that still exist out there. Whether they come back in force and spreads blow out back to, in this case Morgan Stanley back to 450 or 500 over, it's hard to say, but the key point is that we think that their risks are out there, and you can really protect yourself from those risks without giving up much yield at all.
Okay, thanks Justin. I've got Robert asking a couple of questions. Sounds like he's wanting to know, as a new investor, is it still worth investing in the market, or has he really missed the boat? So do you want to answer that one again, Justin or Will?
I might cover that very briefly, and I do cover it in a bit more detail further in the presentation. But essentially, the strategy here is about diversification. So we still think in any market there's still value. So there's certainly a place for some financials. We think that there's still a lot of yield around, a lot of credit spread. If we took these charts back to pre-GFC, the credit margins on most of these US banks was probably around 20 or 30 basis points. So we're still quite elevated from a historical perspective. Having said that, I think pre-GFC levels were a bigger anomaly than were the heights that we saw post-GFC. But we still think that there is certainly a place for financials, and particularly some, as we'll touch on later, infrastructure and other bonds in all portfolios.
Thanks, Justin. I've just got one last quick question before I hand back to Will, and it's from Stephen, and he's saying, why do we need to look at US banks when we have good banks here? Well, I guess, in the over-the-counter bond market, it's just this huge market, and we're looking for best risk-reward. So you can see last year, US banks had a huge margin, that credit spread, so it was paying investors very well for the risks they were undertaking. And one of our recommendations last year was Société Générale. Now, the senior bank debt in about March last year, investors could have earned around 8%, which we thought at that time was a really, really good return for very low risk senior bank debt. So it's not, we're not saying the banks in Australia aren't good, we're just looking for the best risk reward. And as you can see by the chart that Will's shown here, some of those international banks had very good returns for what we thought was very low risk. So I'll hand back over to Will now, and we'll move on.
Okay, thanks for that, Liz. I'm just going to end up now just talking about a current situation in the market, and basically this might present an opportunity for investors, a switch or an investment opportunity. So for a bit of background, basically in early Feb, the fourth largest Dutch banking group was nationalised. It was suffering losses on its real estate portfolios, and the government had to step in. This was SNS Reaal. Now, as part of this, common shares, subordinated and hybrid securities were expropriated by the government, which means investors are likely to suffer 100% loss on those securities as they are taken over by the government. Now, this is an interesting development as it is an example of countries using new bail-in laws, which have been implemented or are to be implemented across most of Europe. And the rules are intended to share the burden of a bank failure with the private sector and not government and taxpayers. So while these laws have been in place in the Netherlands for some time, this is the first time they've actually been used, and the government has taken a hard line and used them to the full extent. Now, this has put a lot of pressure on all Dutch bank debt, especially subordinated debt. So if we just switch to the next page now, we can see one of our more popular securities, the Rabobank 2014 Tier 1, and this is just charting its price. And you can see how the price towards more recent times has fallen hard for these securities and therefore has pushed up the yield. So this presents an opportunity to take advantage of this and possibly secure this security at a more attractive risk-reward basis. In our minds, Rabobank remains a solid, highly rated bank, and its standalone credit quality hasn't changed. Also, the core risk, our opinion on that also hasn't changed, and we still believe that this step-up security will be called at its first chance. Now that's pretty much it from me, and I'll hand over to Justin if there are any more questions.
No, I haven't got any more, but please feel free to type in your question. We want to answer as many as we can, and it's a great opportunity for you to speak and ask the analysts any questions that you might have. So, but Justin will hand over to you.
Thanks, Liz. I'm going to talk about why 2013 is the year to de-risk and diversify. So really summarising our view that we've put out in the Wire and other publications on our website since around early February. And I'm going to expand on some of the themes that Will has introduced, and then I'll conclude with some of the bonds that we think investors should look at adding and reducing from their portfolios. So if we turn over to the first slide, one of the main questions is why now? And the simple answer, as we've sort of touched on already, is that risk is now greater than the reward. So most existing client portfolios, by design, on purpose, are overweight financials, particularly callable bonds being bonds in the subordinated debt and Tier 1 space. And that has been because we thought they were actually undervalued. You know, the risk was less than the reward. But since July last year, credit spreads and risk assets in general, that includes equities and all sort of credit bonds, they've rallied really hard. So I guess in new parlance, that's the risk-on trade. So we've seen a real rally in risk assets. And I've put a chart here of the AXA SA Tier 1 hybrid securities, and the dark blue line is the fixed rate bond, and the light blue line is the floating rate securities. And you can see since around June, July to the peak in February, there's been a really significant increase in price. In the case of the fixed rate bond, it's actually around 29%. If you add the coupons you've received over that period, it's around 35%, and if you annualise that, it's over 50%. So that's a really significant increase in price for a investment grade fixed income security. So credit spreads have rallied very strongly, and that has resulted in prices increasing significantly. However, as we mentioned earlier through Will's presentation, credit fundamentals, while they have been improving and some of the macro risks have improved, we don't think that they've improved to the extent that the market has priced in. So there's been a bit of improvement, but not a material change. So the credit fundamentals, as we say, haven't really changed that much, but the market has priced in a massive reduction. So what's driving the movement? It's really, if it's not credit fundamentals, it's demand and supply factors, also known as technical factors. So really there's a lot of new sources of liquidity come into the market. Quantitative easing, 1, 2 and 3, has been a big factor in the US. The LTRO, the long-term refinance operation out of Europe, has injected a lot of cheap money into the banking system there. And then more closer to home in the Australian market, we've seen a lot of Asian high net worth and high yield investors come into our market, and we've also seen in recent months a lot of new buys from the investment banking market. And what we've noticed, or what you tend to see in a market that has very strong technical or demand factors, is fundamentals go a little bit out the window and people just chase the highest yield. And this is really what we've seen in the case of AXA, back to Will's examples, and Morgan Stanley, maybe some Societe Generale. So those bonds that were the highest yielding have really compressed, and there's not a lot of difference in terms of credit spread or return between the lower risk, more solid credits. So in a market when risk is greater than reward, that gives you an opportunity to cash in at very high levels, and as we'll talk about, it also gives you an opportunity to rebalance these portfolios.
Okay, Justin, just we've had a few calls in about Rabo. So again, it's always my preference to talk things through as we're going through. So I'm going to go back and just ask Will if he can tell us the yield on the approximate yield on the Rabo, and we have Trish, who wasn't quite sure that she understood the opportunity, and perhaps if you could talk a little bit more about it, please.
Sure, yeah, no problems at all. Basically, there's been an event in the Netherlands where Rabobank is domiciled, which has put, I guess, negative pressure on the price of these bonds. And while that's, you know, there is some truth in the market pricing that in, we think it presents an opportunity to actually buy those bonds now. The price has come off a bit, because for Rabo, for example, our opinion hasn't changed of the credit quality of this institution. The market's just reacting, and it gives an opportunity for investors. So looking at that now, given the price has come off a bit, you're looking at a yield for, say, the floating rate Rabo security of around, say, in approximate terms, maybe 5.9 to 6%, or a fixed at a bit lower than that, 5.7, say. So that's pretty much the gist of it.
Okay, thanks, Will. Mark's mentioned here that we had identified Rabo as a reduce in our de-risk and diversify toolkit, and that would have been so, but now with the price coming off, the yield increases. And given that we don't think that the credit has altered, even though that SNS Reaal has defaulted in Holland, we think it's now actually an opportunity to buy back in. So it's a matter of us watching the market for movements in price, and where we think that reward outweighs the risk, or where we think there's a good value for money, if you like. So yes, it was reduced in our de-risk and diversify toolkit, and we certainly need to remove that if we haven't already, but our view is now that since that the default in essence by SNS, that it's the price has come off, and we still see it as good value. So move back on for Justin. Move back
Thanks,
to you,
Liz.
Justin.
This slide tries to, I guess, encapsulate what we're talking about in a simple graphic. So, in very simple terms, what we're saying is take some of those blue dots, sell out of some of those, and move into the yellow and orange dots. So, what does that actually mean? Well, this slide is showing on the horizontal or y-axis the yield to maturity of a number of bonds as at 14th of February this year. The x-axis is actually the time to maturity. So it's in the case of the infrastructure bonds, which are the yellow or the orange and red bonds, that is a defined maturity date. In the case of the blue diamonds, which are the light blue are subordinated debt and the dark blue are Tier 1 hybrids, they're all financials, and we've taken the call date as the expected maturity date. Now, I'll touch a little bit on call dates a little bit later in the presentation, but for the purpose of this calculation, we're assuming these things will be called, and as many of you will know, there's no guarantee that that will occur, but we do expect in the vast majority that it will happen. So what this chart is showing is particularly the subordinated bonds, being the light blue diamonds, the yield to maturity on a number of those has rallied very strongly over the last 6 months to the point where you can now get a higher yield to maturity. So that's a higher return if you hold these bonds to the expected maturity date or call date. If you moved into longer dated infrastructure bonds, the orange ones being just your normal bonds being fixed or floating, what we call bullet maturities, senior debt, and the red diamonds are again bonds issued by infrastructure companies, but they're inflation linked. The dark blue diamonds represent the Tier 1 securities, the most common Tier 1 securities in our market, which are essentially AXA, Swiss Re, Rabo, and National Capital Instruments, or the NAB Tier 1s. Now, while these have also rallied very, very strongly, you can still see there's a number of opportunities to sell out of some of these Tier 1 securities and move into infrastructure, so moving from a lower point in the capital structure higher up into the senior debt and still get a similar, or if you're looking at some of the higher yielding Tier 1s, you are getting a slight reduction in yield to maturity. But essentially, as that little box says there, the idea is to take profits in the blue ones, de-risk, so remove some of that financial risk, some of that exposure to Europe and the US, some of that exposure to call risk and further down the capital structure, diversify and move into some of those infrastructure bonds. So it's quite a simple strategy, but it is in the context of an entire portfolio, so it's around rebalancing. So we look at the next slide. So just to highlight, so the rationale is that a number of those financial bonds, particularly those callable bonds, are now overvalued, or at least they're very high in value in historical terms. Many of them are actually trading over par, and it's important to remember that one of the defining characteristics of fixed income is that bonds are typically issued at $100. They can go up and down, they can trade up to say $110 or down to $90, but when they mature or they are called, they always give you $100 back. So one argument is if a callable bond, such as the subordinated debt or Tier 1s, are trading over $100, then a common argument is to sell it, achieve that money and fix in that return and remove all call risk, because as I said, that chart prior assumes all those bonds will be called. If they weren't called, the yields to maturity would actually be much, much lower. So the minimal upside is the fact that if you look at some of those bonds, the subordinated debt might be trading at a yield to maturity of only 4.5% or 5%, maybe 5.5%. When you think that you still can get term deposits, government guaranteed term deposits close to 5%, albeit in longer dated maturities, there's not a lot of upside in a number of these securities, particularly when some of these bonds are trading over $100. We think there's an opportunity to cash in, but there's significant downside. So if, going back to Will's example, if you looked at Morgan Stanley, if the market in Europe blows up, or if the fiscal cliff comes back in the forefront and people are very worried that it's not going to be resolved, you might see those credit spreads blow right out. Or in terms of maybe the AXA chart previously, you might see that price go from over 100 back to 80 or 90. So the downside is quite large, whereas the upside is minimal. Whereas for inflation-linked and nominal infrastructure bonds, we still think that represents value, and that's by virtue of the fact that they're higher in yield to maturity than a number of those bonds, particularly subordinated debt. So once again, the idea is to use this opportunity of a strong market, reduce the exposure to the financials, rebalance, de-risk, diversify, and move into higher ranking, lower risk bonds without giving up too much yield, or even in fact without giving up any yield.
Justin, we have a couple of questions. John has asked if you might comment on the risks associated with infrastructure bonds.
Yes, certainly. We will touch on this very briefly later on, but it's probably a good point to talk about it. All the infrastructure bonds we are talking about today, and all of our recommendations are actually Australian infrastructure bonds. So we're looking at the domestic economy. So the main risks of infrastructure bonds are probably two things. It's the domestic economy, which we consider is going relatively well, particularly compared to Europe and US, albeit there's the two-speed economy and certain issues in Australia. We think the Australian domestic economy is going pretty well and the outlook is pretty good. By far the biggest risk of infrastructure companies is refinance. So infrastructure companies by their very nature have very high levels of debt because they tend to have very stable, for want of a better term, boring assets and very stable, reliable cash flows. So the biggest risk is refinance risk. Even in the GFC, we observed that all infrastructure bonds, or the vast majority of infrastructure bonds in the Australian market, were able to refinance themselves at good levels. Certainly over the last couple of years we've seen spreads come down. There's very good access in the US private placement market. There's very good access to the bank funding market, and there's very good access in the Australian domestic bond market. So we think that refinance risk is certainly the key risk, but we're very comfortable with that at the present time.
Okay, we have another question from Hanjay. I'm hoping I've pronounced your name correctly. He's noted that today we, in the wire, that Praeco was downgraded by one notch, and that the ratings retain a negative outlook. He's asking if the Praeco IAB, so that's the indexed annuity bond, is still a good investment.
Certainly. There was a number of public-private partnerships that have been downgraded in recent days by Moody's, and this is an expression of their expectations of where refinance spreads might be in a number of years. But in terms of the indexed annuity bonds, one of the key things we like about those is that the refinance risk actually reduces over time. So an indexed annuity bond actually pays a coupon that is indexed to inflation, but each quarterly payment is a part payment of interest or coupons and a part payment or reduction of your principal. So in the case of Praeco, for example, that has a indexed annuity bond that runs until 2020. By the maturity date, there's actually no principal to refinance. Now, Praeco in particular is one that we're very comfortable with because there's no other nominal or normal bonds or normal refinance that comes up until I think it's a month before that indexed annuity bond actually matures. So that's a key thing with indexed annuity bonds is the refinance risk reduces over time.
Thanks, Justin. There's a question here from Uday, and she's asking, is this a good time to buy inflation-linked bonds? I think I'll take this one. I think it actually is a very good time to buy inflation-linked bonds. With interest rates very low, I guess a lot of the risk is that interest rates will move higher now. That'll be the next move. But of course, you can have a rising inflationary environment without interest rates moving higher. And we think inflation-linked bonds are really an important asset to hold for anyone either in accumulation or pension phase, because once you actually hit that pension phase and are drawing down on your super investment, one of the biggest risks to your purchasing power of your capital is that there's an inflation spike, and so a lot of the costs of your day-to-day living, like electricity and healthcare, actually rise very rapidly, which makes it difficult then for retirees to find that additional money. And with inflation-linked bonds being the only security available that is a direct hedge against inflation, and that's because they're linked to the CPI, we think they're actually a very important investment for anyone with a superannuation fund to hold. So yes, we think it's a very good time to buy. Also, because we're not going through that sort of inflationary environment at the moment, inflation's still fairly stable, the prices of the bonds are very good, and you can still buy them at a discount, which means you're actually paying less for them than the face value that they're worth. So they're attractive in that sense. They're also attractive in that the margin over the Consumer Price Index, which is the reference rate for inflation-linked bonds, is quite high and can be over 4%. So if you're thinking that the return on those bonds is inflation plus 4%, very, very attractive, especially when you look at sort of term deposit rates that are under 4 or just over 4%, and here's an investment that's going to give you CPI plus 4%, so we think they're still very, very attractive. There's a few other questions here. I think I'll move back to Justin because I believe some of his presentation will answer them, and we'll try and answer a few more towards the end, and if any questions actually pertain to the slides that Justin's talking about. So I'm going to hand back to him now.
Thanks, Liz. If we move on to the next slide, we look at the extent of the rally in some of these bonds that have occurred. So, sorry, we're just moving on to the next slide. I think it's coming up.
Sorry about that, Justin. That's me.
There we go. So how to read this slide? Again, the same colouring system. The dark blue are Tier 1s, the light blue are subordinated debt, the orange are nominal or normal infrastructure bonds, and the red are inflation-linked bonds. And what this slide is telling us on the vertical axis or y-axis is the reduction in yield to maturity from 26th of July until 14th of February. So over a period of about 7 months, how much has the yield to maturity fallen? So the yield to maturity has fallen on all of these bonds. And remember, there's an inverse relationship between yield to maturity and price. So if yield is falling, price is increasing. So taking AXA as an example, the yield to maturity has fallen 6%, and I think this is an example of the AXA fixed rate bond. So back in July 2012, that was yielding around 14.5%. And again, yield to maturity is assuming it is called. If it wasn't called, the yield to maturity would be a lot lower. Whereas now, or a couple of weeks ago, that was yielding just 8.5%. So the difference between 14.5 and 8.5 is a 6% reduction. Over to the right-hand side, the percentage change, that actually represents a 41% change in the yield to maturity. So it's a really significant reduction. Now there's two key points to look at on this slide. One of them is to notice that all of the largest reductions in yield to maturity are in blue, meaning from financials, mainly the Tier 1s and subordinated debt, and the smallest yield to maturity reductions, so the smallest rally, I guess, in price we've seen, and rally in spreads, has come from the infrastructure sector, be it the nominal or the inflation-linked bonds. So there's been a very, very strong rally in the financial sector. If we move over to the next slide, we look at the same information but in a slightly different way. So again, picking on poor old AXA, if you see there, I'm talking about 26th of July, the yield to maturity was 14.5%, and on 14th of February it was 8.5%. Each one of these bars represents the top value. So the top value was where the yield to maturity was on 26th of July, and the bottom value was where it was on 14th of February. So all of them have performed, all of them, the yields have reduced and the price have increased. The two key things on this slide are to see the extent of the volatility. So you can see that AXA has gone from 14.5 to 8.5. That's a huge improvement, but also exhibits a large amount of volatility. Once again, the blue lines, particularly the tier 1s, the dark blue, have high volatilities. The subordinated debt, and here we've just used a couple of examples, 3 Vero bonds and a National Wealth subordinated bond. They still exhibit a large amount of volatility. And then if you go over to the infrastructure bonds, much less volatility, so they haven't outperformed to the same extent. So one thing to note is volatility, and the second thing to note is that upward sloping arrow. That is demonstrating that the return you can achieve by moving out of a number of these financial securities into, albeit longer dated, infrastructure securities, you're actually picking up a return in many cases. So it's not just about the volatility, but it's also about removing some of that risk and moving into higher yielding bonds, particularly if you're comparing the light blue subordinated bonds with the tier 1s. There might be a little bit of give up in return. So the question is, why add infrastructure and inflation linked? Well, we've really covered why we think the left-hand side, why we think that the financials have rallied very strongly and arguably are overvalued. The second part is, well, you can move into safe, secure, senior ranking infrastructure and get a higher return, and as Liz mentioned, also get some very strong inflation protection by moving into some of these infrastructure names.
Okay, Justin, we've got quite a few questions here, so we might try and answer a few if that's okay by you. Arnold here has asked, what's your opinion of the value of the fixed Swiss Re, and are you confident that they will call in May 2017?
Swiss Re probably remains our favoured tier 1, notwithstanding the commentary on Rabo. We still like Rabo, but Swiss Re in particular, we're very comfortable with the credit and we're very comfortable with the call risk. So one thing I haven't talked a lot about yet is call risk, so it might be a good opportunity. We still think, and anyone who read The Wire last week would have seen a number of articles around call risk. Our view is still that the vast majority of these bonds that we're talking about, the ones that we've been, for want of a better term, recommending for the last couple of years, we still believe the vast majority will be called. Australian companies and Australian banks and insurers, we're very comfortable with call. In Europe, it's really a case-by-case scenario. So we really only look at 3 European in the Australian dollar market. We've got AXA, Swiss Re and Rabo. And we're still comfortable with all those 3, but of the 3, AXA has probably reduced in probability recently because of some regulatory developments, which I was going to touch on a little bit later, but I can talk about now. Essentially, there's a thing called Solvency II, which is the regulations for European insurers. It's essentially the Basel III version, which applies to banks, but Solvency II applies to European insurers. Bank regulation is very clear now, and what APRA has adopted and what Basel III globally has adopted, that step-up securities are no longer wanted. Essentially, the regulators want them called and they want them out of the way. If a step-up security is not called, it goes to 0 weighting in their capital calculations. And while I'm talking about that, some of our listeners might have read about ANZ not calling a retail hybrid in New Zealand dollars last week. It's very important to realise that that wasn't a step-up security. It actually is a reset security which will step up in another 5 years. So we're not at all concerned that it's a signal that ANZ and other major banks are not going to call their subordinated debt or Tier 1s in the near future. We weren't surprised by that at all. But getting back to the question on AXA and Swiss Re, or particularly Swiss Re, we're very comfortable that Swiss Re will continue to call. They have said that very clearly to investors and to ourselves in a number of briefings. They have the strength, they have the ability, but all call decisions come down to the company's strength at that time and whether the regulator will allow them to call that. So failing any significant change in their credit strength, maybe if there was a huge amount of natural catastrophes just before that call date, that might change our view, but we're still very confident with Swiss Re. And comparing Swiss Re return, if you're looking at this chart that's up on at the moment, Swiss Re, albeit a little bit longer, is yielding around about 8%, AXA around 8.5%. This is a great example of a significant increase in risk for only a 50 basis point increase in return. So AXA is 4 notches lower rated than Swiss Re. Swiss Re is a much better company, but when the markets rally, we've seen some examples of a chase for yield, and people were just buying the highest yielding bond, which in Australia is really AXA, and we think AXA in particular has probably come in too far. So hopefully that answers the question on Swiss Re and covers some issues on call risk.
Thanks, Justin. Mark's asked, he's brought up that Swiss Re is on our reduced list again on the toolkit page. I think it's really important to highlight, and Justin mentioned this, but we're talking mainly here to investors that already hold these securities. So they already hold the securities. They've seen a big increase in the price of the securities. So we're thinking now's a good time to take some of that profit and take some of that off the table to ensure that it remains, if you like, and that we see there is the potential for the price to decrease again if there's a big event risk in Europe or the US. However, if you are starting a portfolio, these securities do provide very good yields, and we would still recommend perhaps having a small allocation to them in your portfolio for the yield. We are still generally confident that they will call at their first call date, so it's not so much about the risk, it's more about that the price has increased significantly and the profit's there for the taking, if you like. So we don't see that there's as much upside as there was when we originally recommended them, and we know some of our investors hold very large holdings of AXA and Swiss Re, and that you know, they could possibly think about selling down some of their holdings. We're not saying sell everything, and we're not saying sell even. We're just putting it forward that we think now might be a good time to consider rebalancing your portfolio away from those financials to some of the more senior debt type securities. I'll just hand over to Justin. He might want to make a little bit of a further comment there.
Exactly. So as we talked about earlier, it's really about a portfolio context. So I think on the reduced list is a number of these Tier 1 securities. The idea is if you had a portfolio that maybe had 3 or 4 Tier 1s and 3 or 4 subordinated bonds, you might just reduce 1 or 2 from the subordinated debt and 1 or 2 from the Tier 1 allocation. So it really depends on your portfolio. And one thing that Liz mentioned there, we're not using the words sell and buy, we're actually using the words add and reduce, because it's really about that balance in that portfolio. Another way to look at it, what's happened is exactly what we were hoping would happen, and probably has gone a little bit further. We were recommending people go overweight into financials, names like Swiss Re and AXA in particular, because we believed that the market was underpricing those securities, or was overemphasizing the call and credit risk. Now, in particular the case of AXA, as I'm sure people have worked out by now, it's really run too far in our estimation. So we think now is the time to take some risk off the table. So it might be if you had 200,000 of AXA, you might sell half and just hold half of it. So it's not an outright sell, an outright buy. It's not you need to panic. These things are terrible. It's just a rebalance of your portfolio.
Okay, Justin, sort of part answers David's question, and he was saying that he bought AXA in July 2012, and he's just asking, is it true that the only benefit from selling now is to capture the higher price, and the yield to maturity remains the same as when he bought them, doesn't it?
Well, the yield to maturity when David bought it was 14.5%, but that has been adjusted now. It's reflected in the price. So if he was to do a back-to-back buy and sell, the yield to maturity would only be 8.5%. So yes, he has bought a very good bond at the right time, but as I mentioned earlier on, it's actually increased up to, annualized, it's increased 50% or more in 7 months. So it's had a very, very strong return. And by selling out now, he's capturing a lot of that excess yield to maturity. So it's just like exactly the same as a share. If a share, you bought it at $10 and it's now $20, well, yes, it's great that you've bought it at $10, but you've got to look at the relative values at this point in time. So it's important to look at the yield to maturities now and what else you can reinvest. One of the key risks, which we'll touch on, I think, in the next slide, or the downsides from this de-risk and diversify strategy, is particularly with AXA and to a lesser extent Swiss Re. By moving out of those bonds, it is hard to replace those bonds at the same type of returns that you were receiving. But in the context of an overall portfolio, we think the yield to maturity reduction will be minimal, depending on what you hold. So, but for a significant reduction in risk, and then we're not saying that the market is going to blow up again, but if it does, then you would expect us to say, well, the risk return has changed back into favour of AXA and Swiss Re, and now is the time to maybe go overweight in those names again. So hopefully that gives a bit of context to what we're trying to suggest.
Now, just one last AXA question. I've got a raft of questions about inflation-linked bonds, but I think I might leave those till towards the end of the presentation, and we certainly will comment on which bonds are suitable for retail investors as well. But one last AXA question. John asks, AXA in Great British pounds has not rallied like AXA in Australian dollars, and he's wondering how we view this in relation to our discussion.
Actually, one of the topics we'll cover very briefly a bit further down the track is non-Aussie dollar bonds. There's certainly many opportunities, particularly in the Tier 1 space, of arbitrage opportunities or examples of where bonds are trading at much better levels in different currencies. And we see this particularly in AXA and also the major banks, where the difference in yields or the difference in credit spreads, so it's probably best to look at credit spreads when you're comparing cross currencies, because obviously the interest rate environment is very different in Europe as it is to Australia, but the credit spreads can often be very different. At different points in time, we've seen AXA being much better value. At the moment, the Australian dollar one has, in our view, essentially what we're saying is run too far, and one of the indications we've used for that assumption is that it has run further than the European version, which is the home market, a more liquid bond in that market, because people know that credit and trade that credit extensively. So that is one of the indications that we have used to say the AXA Aussie dollar is possibly overvalued, whereas the AXA euro is maybe fair value or less overvalued.
Okay, Justin, I think it's time to move on with the presentation. So we're near the end, and we'll certainly tackle those inflation-linked bond questions at the end of the presentation.
Yeah, thanks, Liz, and I think in the coming slides I will touch on a little bit more about inflation-linked again. So really looking at the context of what we're talking about, what are the pros and cons of essentially moving out of some financials and into some senior ranked infrastructure. Probably the main pro is the diversity. So as I mentioned early on, most client portfolios have been by design overweight financials because that's where the best value was. So moving out of some of those financials into infrastructure and other corporate bonds is really addressing that overweight financial sector, also overweight call risk and overweight subordination risk. And remember, one of the extreme example of subordination risk is Will's example of SNS Bank. in a crisis scenario, if you're in a subordinated debt or Tier 1 level, when a bank fails, it's highly likely you're going to feel significant haircuts and possibly completely wiped out. Now, all the names that we look at are very strong, highly rated global banks and insurance companies, but it is important to keep an eye on what subordination risk really means when it hits. Also, call risk. You know, we've glossed over call risk a little bit. And particularly with our calculations, we're assuming all those bonds are going to be called. Now, we still think there's high probability of call, but call risk, for example, only 50% of bonds, callable bonds in Europe were called last year. So in Australia, the Australian market is very strong. The banks and the Australian insurers continue to call all step-up securities. Remember, we like step-up securities. Those that aren't step-up securities is a different kettle of fish. But call risk can change. So if it becomes the norm that, you know, if someone steps out of line, Westpac or ANZ all of a sudden don't call a security, there is risk there. So don't forget about call risk, even though the market is almost discounted it, whereas going back 7 months ago, a big part of our push into financials was that they were overestimating the call risk. One of the other big pros is that capital structure. So you're moving up from subordinated debt into senior, and in particular senior secured bonds. So a number of infrastructure bonds are actually senior secured, meaning you actually have security over that infrastructure asset. So you're moving up from the Tier 1 and subordinated space into the senior space. And again, regular readers of our material would have seen plenty of representations of our capital structure graphs and how important that is to know where you are in the capital structure. And this is giving you an opportunity to move significantly further to the top of the tree, close to the top of the tree, without giving up too much return. Again, we've talked about minimal upside and also minimising downside risk. So we think that there's not a lot of upside left, but if Europe was to blow up, for example, and I know I shouldn't use the term blow up, if Europe was to deteriorate, or if the political situation in Italy or Spain was to really increase in uncertainty, we might see a risk-off period, and you could expect that the financial securities would really deteriorate in price and spreads would blow out. But as that chart showed, the volatility or the movement in infrastructure seems to be a lot less. The next point there is obviously less volatility, and that is around the same sort of downside protection. There's minimal downside. We're minimising downside by moving into a lower risk portfolio. And inflation protection is something that we've talked about, and there's been a number of questions. So there's two types of inflation-linked bonds there. There's capital index bonds, and they are bonds that increase in value over the life of the bond. So each time inflation comes out, the face value or capital value of that bond increases by the amount of inflation. So a Sydney Airport bond might have been issued in 2006 at $100. When it matures in 2020, that capital value might be $150, for example. There's also index annuity bonds, which I talked about in the Preco example. That's the reverse. It pays down over the life of the bond. The index part is the coupons or the interest each quarter, but your principal pays down over the bond, a bit like a mortgage. So inflation protection is a really big theme that we've been talking about for many years at FIIG, but really 2013 we think is a really big year for inflation protection. I'll touch on it a little bit later, but we've also done some, we have a number of model portfolios that we've just updated under the, I guess, the de-risk and diversify theme. And one of the changes there was to move inflation from around about 15% allocation to around about 33% in each of those. There's a retail low risk and there's a wholesale high yield portfolio. So we really think that inflation protection is important, but also it's amongst where the best value is in the market, and we'll see that in a couple of slides' time. So what are some of the cons, or what's the downside of moving, making some of these changes? Well, the first one is probably that there's less upside. So if markets do continue to rally, if the risk on just remains, arguably you could have made more in the callable bonds. I'm not so sure if there's a lot more juice or a lot more upside in a number of the subordinated bonds like the Veros and the National Wealths, which are already trading at levels only in the high 4s or low 5s. But possibly in the tier 1s, the AXAs, those sorts of things, maybe you could have made more than you would have in the infrastructure bonds. But it's not necessarily the case that you will have made more money if you maintained extra overweighting to financials. And it's important to note that all those bonds would be expected to improve in such a scenario. You are giving up or extending maturity, so you are taking a longer maturity view by moving into some longer dated bonds, albeit a lot of those are inflation linked, and typically inflation linked are long dated because you are protected by that direct hedge against inflation. So potentially you could be taking more duration risk or interest rate risk, but there are fixed and floating versions of these infrastructure bonds that are available if you are worried about that. And also when we're talking about taking longer maturity risk, that is assuming all those callable bonds are called at first opportunity. Just reminding everyone, tier 1 securities by their nature are perpetual, if not called, and typically insurance subordinated bonds will extend for up to another 10 years if not called, and bank subordinated bonds will extend by another 5 years if not called. And the last con or downside is potentially give up in yield. And this is really in the pursuit of de-risking from the tier 1 bonds, so mainly the AXAs and the Swiss Re's. If you were to sell down, you're probably going to be switching to something that's a lower yield to maturity, but for the subordinated debt, in many cases you actually are getting an increase in return. So we now move to, I guess, what a lot of people want to know, or some of the questions is, what bonds should I add or reduce from my portfolio? And again, remember it's in a portfolio context, and it really depends on what you have in your existing portfolio. And it also can be applied to new clients who are looking at setting up a portfolio now. What sort of balance should I have? So if we first look at the reduced list, and again, we're not using the word sell. It's not a panic. It's just a readjustment. No surprise, I'm guessing to most people who have listened, AXA is probably amongst the first that we think that should be reduced. We're not saying that that you have to go out and panic sell them, but we think that these ones in particular have the most exposure to a downturn in Europe, and also have got the most uncertainty around call risk. So our probability of call for the vast majority of other things haven't really changed, but for AXA it has reduced a little bit because of uncertainty under Solvency II. Particularly the fixed rate bond, which has performed very well. As we said, it's gone from $80 to over $100 in a 6 or 7 month period, so that's a very strong return. National Wealth subordinated debt, which is a 2016 fixed and floating, and there's a number of Vero insurance bonds, or Suncorp insurance bonds, 2014, 15 and 16 call dates. While we remain confident of the call of all Australian banks and insurance companies, the reason we think that it's time to reduce or look to exit some of these exposures is really around the lack of upside. They're trading at only 175 to 250 over, or a yield to maturity of anywhere from 4.5 to 5.5, depending on which bond you're looking at. And again, when you can consider that you can get a government guaranteed term deposit close to 5% still, albeit in the longer maturities, that might be a spread of as much as 150, 160 over. So there's not a lot of additional I guess, return from a much lower risk security such as a term deposit, albeit there's a lot more liquidity in bonds. So we think you can on each CPI or inflation release. So each 3 months, the value of that capital increases. And these are really suitable for those who are in accumulation phase, particularly in the pension The next category are some indexed annuity bonds, and remembering these are the ones that pay down principal and interest over time. We've chosen two, but there's actually a number that exist in the market. All of them are issued by public-private partnerships, which we've already discussed briefly. The two that we've chosen are Preco, and again, one of the reasons I like this, albeit the Preco has recently, just in the last few days, been downgraded on refinance risk. This Preco bond is a very short-dated index annuity. It actually runs out in 2020, and the only refinance that Preco has prior to that is 1 month before. So your very worst case scenario that Preco was unable to refinance, you would have already received 99% of the value of your bond in this case, or maybe 95%. The GEMS New South Wales schools, that's actually a project where they built 11 schools in New South Wales. Both Preco and the GEMS New South Wales schools have passed the high-risk construction phase, and all they are now is in the maintenance phase of a PPP, or public-private partnership. So they have performed, or they have built infrastructure, social infrastructure for the government, be it the state or federal government, and now they are just maintaining that infrastructure and getting income streams or rent payments from the government. So the GEM New South Wales schools is a very highly rated index annuity, and that actually runs down until 2031. So that's a good one for those looking with a longer time horizon. And again, being a principal and interest pay down, a bit like a mortgage, these are good for investors who are in that pension pay down phase. And once again, highlighting that one of the key credit risks between the two, capital index bonds, the refinance risk actually increases over time. The index annuities, the refinance risk reduces over time. And finally, one or two types of, or two categories of securities to consider, particularly for the sophisticated investors, is residential mortgage-backed securities. So they're RMBS, or a collection of loans that Australian banks or credit unions have securitized. We see a number of opportunities there. There is still some value in that market, and certainly we've done a number of seminars. It's a very different type of analysis, but there's a lot of material that we can provide investors who might be interested in investing in essentially Australian property and Australian mortgages. The yields can be anywhere from a margin of 100 over for some very, very high quality, low risk bonds to as much as 1,000 over for some very interesting and higher risk, but albeit we think good reward for risk RMBS. The last category there is some non-Aussie dollar subordinated debt and Tier 1s, particularly from Australian banks and insurers, but as we had a question earlier around AXA in euros, often we see some very good opportunities in euros, US dollar and sterling issues, mainly from Australian banks that we know and love, but in the subordinated debt positions or Tier 1 positions, and the spreads might be as much as 200 or 300 wider than where we see the exact same structure security trading in Aussie dollars. So there's certainly some opportunities there. Obviously there's some currency risk that your dealer would have to run you through, and there's some strategies for dealing with that, but we do see that there's still value in that market. So now that we've gone through some of the bonds to reduce and add, and Liz will touch on this a little bit later, there's also a landing page or a section on our website with a large number or a much larger number of bonds to add and reduce. We might just wrap up on the final slide our conclusions, what we've really been talking about. So, as we said, existing portfolios by design have been overweight financials. We were hoping for a very strong performance in financials. That has now happened, and to the extent we think it might have even gone too far. So we think those callable bonds are now possibly providing less return than the risk that's presented. So macroeconomic and call risks remain out there. So we're not certainly things have improved, but we don't think that they've been addressed. The fiscal cliff has just been pushed further out. The European situation hasn't been resolved yet. The LTRO is really one of the things that is just smooth it over for a couple of years, but growth remains anemic in Europe. So macroeconomic risk really remains. So the key thing is risk is now greater than the reward or return you're getting on those financials. However, the infrastructure, and particularly that some of those inflation-linked bonds, haven't seen the same outperformance. We haven't seen the same volatility. So we think it's a good opportunity to take the opportunity of very strong, very high prices for financials, reduce some of that exposure, take away some of that core risk, and improve diversity in portfolios, move back to a more balanced portfolio. So rebalance, de-risk portfolios, move up the capital structure, move up from the subordinated debt and Tier 1s into senior, and add some of that infrastructure, and particularly some of those inflation-linked bonds, A, because of great value, and B, because of the inflation protection. And just the last point, however, new investors listening to this might be thinking, oh, I should just avoid all financials. It's in the context of a balanced portfolio. So an allocation to some callable financials, particularly Tier 1s, providing very high yield, is still recommended. It's just about a balanced portfolio. So that concludes the presentation part, but it sounds like we've got a number of questions, so I'll pass back to Liz to see what we've got.
Okay, Justin, I might let you take a breather. That was great, thanks. Okay, I'm going to attempt to answer some of the inflation-linked bond questions. There's quite a lot of them. First of all, with inflation-linked bonds, the coupons or the interest payments are paid quarterly. So every quarter you get an interest payment that is essentially a yield plus inflation. So you get a margin over and above inflation. Now the way these bonds work is that each quarter when the CPI figures come through, there's actually an index or a figure, and the face value of the bond increases over time. So while most bonds are issued at $100 face value, inflation-linked bonds, that $100 value increases. So now the Sydney Airport 2030 bond, the face value of that original $100 is now about $118.75. So that if that bond matured tomorrow, Sydney Airport would owe investors $118.75. So that's where you get the increase for inflation. Now the coupon itself per se doesn't increase, but it's paid on the total face value. So it is a growing coupon of growing interest payment to you. So I hope that explains exactly a little bit more how they work. Now we do have inflation-linked brochures, and actually you can find them online on our website as well if you're interested, which actually go into a bit more of the technical explanation and show some of the mathematics behind those calculations. Now we see, I've got another couple of questions. Doug is asking, why is inflation protection now more important than it was 12 months ago? I would say that inflation protection is important all the time, and with my own model portfolio, I would suggest that investors would always hold a sort of a minimum of 10% inflation-linked bonds, because again, they're the only bonds that have that that protection and that direct link to the CPI. So I think now market commentators are more concerned about inflation because of all the liquidity and all the money sloshing around. So if we take Europe as an example, they're printing money. That's the way a lot of these economies that are in trouble are figuring they're going to get themselves out of trouble. They're going to inflate their economies. We're seeing that with Japan and to some extent the US as well. So globally, commentators are concerned with all this money and being offered at very cheap rates, you know, around 1% or less in some countries, some economies, that eventually all that stimulus, it's stimulating the economies and people to borrow and to spend, that they see that there's a big chance that inflation will spike. So I guess there is an increased concern about inflation now over the last 12 months, but I would still argue that it's important to have an allocation to inflation-linked bonds. And Justin, you want to chip in?
I'll just add one point there. It's also about relative value. So a year ago, AXA was was trading at or giving you a yield to maturity of 15%, whereas those inflation-linked bonds were maybe 7%. Now AXA is only 8.5%, and the inflation-linked bonds are 6.5%. So it's around about relative value, and a number of those bonds you'll notice are credit bonds, so they're not government inflation-linked bonds. We think it's a combination of the credit return you're getting and also the inflation protection. So it's also a relative value assessment compared to a year ago.
Okay, there's a couple of other inflation questions here. Hans is asking, how do we see the liquidity risk in the various infrastructure products, the IAB, the C and the CIB? Of course, a lot of liquidity is dependent on the issuer of the bond, and we have the Commonwealth Government issuing CIBs and state governments as well, and very low-risk entities. The Commonwealth Bank, for example, issues a CIB. So they're low risk in themselves, and we would expect a good liquidity on the low-risk names. Now, as you take on more risk, you have additional liquidity risk, and that's part of why bonds with higher margins pay those higher margins. So you see that in perhaps Sydney Airport, where it's slightly higher risk than those other bonds, and so you're being rewarded for that. We haven't seen any issues with liquidity in our market to date, and I've been with FIIG for 5 years, and we've been through some fairly tough times, but that's not to say it couldn't be an issue in future. But at the moment we don't see that. I guess particularly with the IAB, so they're the inflation-linked bonds where that are particularly good for investors in pension phase, and so they return principal and interest on every payment. A lot of investors would buy those with a hold to maturity view, so they're not concerned about liquidity, they're concerned about inflation protection and that monthly income, if you like. So now I'm just looking through the questions. How does deflation affect the bonds? Andrew asks.
In the inflation-linked space, the vast majority of bonds, and I believe all those ones that we've put up, the capital value can actually reduce, but only to the point where the capital value gets back to $100. So if inflation if you'd bought the Sydney Airport bond at $100 and it's now 118, I think you said, Liz. If deflation came out and it was negative 5%, that would actually go down in capital value, but it can only go down to its original face value. Now, having said that, I think there's been 1 or 2 quarters in the last 10 or 15 years, I might be wrong here, I'm not the economist, but it's very rare to have deflation in Australia, and certainly for prolonged periods. But it will reduce, but it can't go below its original face value. One of the tricks there, if you have enough options there, particularly around the government-issued inflation-linked bonds, is to protect yourself against deflation, is to buy something that was only recently issued, so it's closer to that $100. If it's been in existence for many years and it's gone, its capital value is now $120, in theory it could fall another $20 back to 100. It was only issued last year and it's now $103. The worst it could do is come back to 100.
Okay, I've got a couple of questions about BrisConnect and very recent failure, gone into receivership. So Walter and Warwick are asking what impact that has on our market. Well, BrisConnect was a toll road operation in Queensland, and we've actually seen other toll roads go into administration, like Lane Cove and the Brisbane Cross City connection. So we've seen this before in the market, and there hasn't really been any effect on the broader market and other infrastructure assets. I guess the reason BrisConnect failed, or the reason for its failure, was that traffic numbers or volume didn't actually translate from the analysts' initial reports into actual traffic. So the infrastructure assets that we look at generally have sort of little or no volume risk, have long-term contracts, and that risk is minimised. But One of the things I want to point out is that we have an infrastructure analyst, Gavin Madsen, who's been in the industry for many years and worked actually with Fitch ratings. So Gavin writes very detailed research on all the infrastructure assets, and if you have a particular concern, certainly we can send you the research, or you can even speak to Gavin if you'd like. So we do our homework on these things, and we like to think we recommend the assets with the best risk-reward value, as we mentioned. So just going through some of the other questions, Doug has asked, could we give an example of a good infrastructure bond? Perhaps, Justin, do you want to pick that one up?
I guess on the previous slide, it was really any of those Dalrymple Bay, Dampier to Bunbury, Sydney Airports, Investra, or any of the capital index bonds. So depending on your circumstance, your age, or how close to maturity, the types of returns that you're looking for, cash flows. But from a infrastructure bond, we're very comfortable with all of those, particularly those monopoly type assets, the gas pipelines that are very hard to replicate. The cost involved of someone else coming in and replicating a gas pipeline or network is very, very prohibitive. They are boring assets, not a lot happens. The key risk is refinance risk, and as long as we're comfortable that the Australian economy is going to go well and the refinance for strong, high quality assets remains, and the banks and the bond markets are very keen to finance these securities, we remain comfortable in those names. And I just echo again what Liz said. We do have an infrastructure analyst here, Gavin Madsen, who has research on all the names, and for that matter, every name that we've talked about today, we have detailed research on our website or via your dealer.
Okay, now Gordon has asked, it seems like holding a bond portfolio requires much the same monitoring and work as holding a share portfolio. Is this so? Will, would you like to take that question?
Yeah, sure. I mean, yes, and I guess any investment you need to monitor the market and understand what's going on. But I'd say it just depends on where you sit personally. There's plenty of options out there to buy investments which are set and forget, if that suits your investment, or other ones which require higher monitoring. One thing I will say is, if you're holding a bond portfolio, we do monitor these types of companies ourselves, so we're the ones doing the coverage and keep our clients up to date when need be.
I might just add a point there also, Will. I guess this call to de-risk and diversify is a significant call in terms of our change in strategy, and probably the last time we made a significant call was actually December 2009. So it's not often that we make large changes to a sector recommendation. So a number of bond portfolios can certainly be set and forget, and a number of our existing clients are very happy holding their overweight financials and happy just on a yield to maturity basis, knows that there might be volatility in between, but happy with what they've got. They know that their cash flows are coming in, when they're coming in, their maturities, albeit there's some call risk, but they're very comfortable with that. So yes, all investments you should always be watching, but certainly bond investments, I think there's a little bit less than the equity markets. And from our strategic point of view, I've been here almost 6 years, and I think it's probably the third change we've made from a large strategic point of view. So it's obviously not a weekly or monthly thing.
Okay, just a couple of last or final questions. I've got clients asking which are the retail bonds you would suggest switching into, and also Ken has asked, could you please give an example of a switch from a tier 1 to secured where you would not give up any yield to maturity. I think there where, Ken, you're talking about secured, I think maybe you mean senior debt instead of secured. Secured bonds, an example of a secured bond might be like a covered bond where there's a direct pool of assets securing the bond. So they're actually very, very low risk, and I don't think we could actually find a secured investment going from a Tier 1 to a secured one, but perhaps we might be able to find a senior bond. Justin, do you want to comment on those couple of questions?
In terms of retail options, unfortunately all of the Tier 1 bonds are only available to wholesale. So in the financial space, the vast majority, but not all of those subordinated bonds, so a number of the Veros and certainly the National Wealth are retail bonds. But the good news in terms of the inflation area, all of those bonds are available to retail, particularly the inflation-linked bonds, the CIBs and the IABs. So there's certainly a lot of options for a lower risk retail portfolio. In terms of opportunities moving from a Tier 1 into a infrastructure senior secured bond, so most infrastructure bonds actually are senior secured, so you do have security over that infrastructure asset. Take out AXA and Swiss Re because the yields to maturity on AXA are around 8.5%. Currently Swiss Re is around 8%. There aren't any bonds where you can switch into which will give you those sorts of returns. But even if you were switching out of some of the RABOs and particularly some of the national capital instruments, you can switch into the longer dated Sydney airports with a yield to maturity of around 6.95, I believe. So you can get a slightly higher return by switching out of some of those Tier 1s. Yes, so the Sydney Airport 30s, a 6.95% yield to maturity, assuming 2.5% inflation. So the AXA and Swiss Re, you will have to give up some, but the RABOs and the national capital instruments, there's the opportunity if you're prepared to go on the 2030 Sydney airports, where you can actually get a similar or higher return, and that's going from a Tier 1 level to a senior secured level.
Okay, two last questions. I've just looked at the time and we've been talking for a long time, so I'm very pleased to see a lot of you still on the line. But just quickly, we have, where is it? Mark's asking, couldn't you argue that the lack-in rise in value of an inflation-linked bond is due to continuing low expectations on inflation? Certainly that's true, that the price is low because there is that low expectation, but we actually think now is a good time to lock in before inflation starts, because when inflation does start, the discount on that those bonds will disappear and may even go to a premium. Justin, do you want to?
And again, a lot of the return in those inflation-linked bonds is the credit return. So government, particularly federal government inflation-linked bonds, have been very, very strong performers over the last 6 to 12 months. So it's not so much about all about the inflation expectation. There's also a lot of credit return in there. So good relative value.
Great. And just very last question, and this is one we get quite often. Andrew's asking, are there any tax concessions similar to share franking credits for holding bonds? There's not, Andrew. It's quite an uneven landscape in that regard. Although there are on some of the listed hybrids some franking, but in the bond market, no, there isn't any in that regard. We have Bruce and a couple of others asking about residential mortgage-backed securities, the RMBS, and are we going to have a webinar or more information on those? Certainly if there's demand, we will, and we want to educate our clients, and it's good to see that interest. So Bruce will certainly be contacting you. We'll take your name down as an interested party, and please let us know if you're interested in any of the products that we've talked about today or the securities. We do have a lot of information available on our website, a lot of research, a lot of educational material. We are actually in the throes of rewriting the Australian Guide to Fixed Income, which we hope to publish in the next few months. It will be a much larger and more technical publication, and certainly want to make sure all of our clients have a copy. So keep a lookout for that. Of course, we have the online course, the Fixed Income course, which is accredited by the Financial Planning Association. And we do have a landing page on the website regarding our de-risk and diversify portfolio. And of course, we're all here to answer any questions if you want to give us a call or email us or talk to your dealer. So that concludes this afternoon's presentation. Thank you very much for joining us. Again, we're more than happy to answer any questions you have, and we look forward to providing more webinars throughout the year and talking to you. So thanks again. Good afternoon.